Ladies and gentlemen, good day and welcome to AIA Engineering Limited Q2 and H1 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Kunal Shah from AIA Engineering Limited. Thank you, and over to you, sir.
Thank you so much. Yes, thank you so much. A very warm welcome to everyone. Good evening. This is Kunal, and I have Sanjay Bhai along with me here on the call today. As I get into top line numbers, and we'll share a little update on the business, and then we can get on to Q&A. I think second quarter is largely in line with the first quarter of this year. No remarkable financial difference. Things look steady state by and large as far as operating numbers are concerned. I'll still run through a quick summary, and then we'll get on to the business bit of things. We sold about 63,000 tons for a total of about 123,000 tons for the half year. That compares to about 120,000 tons that were done half year last fiscal year, and up from 60,000 tons that were done second quarter last year. We've done about 63,000 tons this year, which translated to 1,029 crores of top line, and EBITDA of 395 crores, and profit after tax of 277 crores, for the quarter. So overall, from a financial number standpoint, the quarter looks largely okay and in line with the previous quarter. Further breaking up our other income, the total of which is about 98 crores, 33 crores of that belongs to foreign exchange, and in that sense, it's an operating other income. We also have 18 crores of export benefits and about 64 crores of treasury income. So the total other income is 98 crores is other income, and export benefits it's about 18 crores, about 116 crores of other income for second quarter of this year, and almost similar to what we earned in the second quarter last year. Nothing remarkable from a working capital standpoint. All our debtors and stock, etc., largely in line with what we've done historically. From a tonnage standpoint, we did 63,000 tons, of which about 38,000 tons came from mining and 24 from non-mining. And again, so there's a small increase in the non-mining bit. Mining bit continues to be flat between second quarter of last year, and slightly up from the first quarter of this year. We've had some, our average realization for the quarter is at 163 rupees, and that reflects, product mix. I think raw material costs are largely, comparable to the first quarter, so no large difference between the two. There are some numbers, around power and fuel and other operating metrics where some bit of renewable captive, as it gets online, there is some implication, but largely comparable from an operational standpoint. Nothing that's a large delta change. From a business standpoint also, things continue, all things that we've, spoken about in the past around work that we're doing with the mines. I think all our efforts continue. There's a very important development that we shared about our customer in Chile. We're not, sharing the name because the customer would not prefer for us to speak about it on a public platform. But very interesting customer. They've shared a contract that will last over 18 months, and their consumption is going to be variable because it goes up and down, but our sale per year will vary between 13,000-14,000 to 17,000-18,000 tons, depending on their throughput and other things. So let's say about 15,000 tons a year is volume that we expect out of that. But more importantly, over and above the win, it is an important endorsement. It's a very important customer, and it's our first breakthrough or a first win, in that important South American market, and first ever customer who's now using high chrome for their branding media. So it's a big milestone for us from a directional standpoint and an endorsement of all that we are trying to say. Our solution is designed to offer far more benefits than than a typical branding media offering has been historically doing, and that includes mill liners and design changes within that and a whole solution engineering that we do. So we continue to remain very excited. We are digging in our heels and putting in all the effort to make sure we have small wins and hopefully bigger milestones and good news to share. I'll have Sanjay bhai share a little bit more on it, and then we can get to Q&A.
So thanks, Kunal, and a very warm welcome and a good evening to all of you. So as Kunal indicated, and as we had hinted even during our first quarter call, there is a very, I would say, a remarkably exciting shift in terms of our approach as a package, what we are now offering, where a very unique liner-driven solution, where as a package, the liner plus grinding media solution offers very exciting benefits to our end users. We had, so that would very quickly improve the throughput significantly, as well as reduce the power and other operating costs, which makes our solution unique. In a way, it takes us away from, doing the risk of pricing and then, anti-dumping and all other associated problems. And more importantly, as Kunal we have also made that announcement, we have taken successful trials based on this new approach with quite a few mines. And as we speak now, 2 large mines are also under trial, very important mines, I would say. Plus this recent order that we have won, all of that makes us confident that going forward, we had also indicated that while this year we may expect some increase in the volume, maybe 5, 10, 15,000 tons. But from next year, we are very confident that we should be able to demonstrate year over year a sustained growth in terms of increase in volume, which has so far been one of the, I would say, a concern areas from the investor standpoint. I think with this, let the house open for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Bala Subramania from Arihant Capital. Please go ahead.
Good evening, sir. Thank you so much for the opportunities. Sir, what is the tangible evidence for conversion pipeline, especially for forged to high chrome side? And are you seeing any change in RFQ process from mining customers, especially requesting high chrome or integrated liner media solutions? Can you cite the top 3 to 5 conversion opportunities in your pipeline?
So, Mr. Bala, one is, of course, as you very rightly said, the proof of pudding is in eating. We have got one major order whose announcement we have made. One Chile, very important customer, where the order size is on an 18 months is about 22 to 23,000 tons and about $33 million order. That is one straight evidence of a conversion. Correct? More importantly, as I said, we have conducted successful trials in about 10 to 12 mines, including in India, very important mines, very important iron ore producing or zinc production mines, and overseas in Nigeria, in Ghana, in a few very other important locations where we have seen that the customers get the tangible benefits. Based on that, now currently we are in trial, very advanced stage of trial, where in the months of December and in the months of Jan-Feb of this fiscal itself, we will start getting the final outcome of those trials. These are very large mines, much bigger than what we have been conducting. So what is going to happen is that over the next 3-4 months, you may come across a couple of other such announcements where this is obviously, plus please understand our current business is ongoing. As you see from a sales or an EBITDA standpoint or from overall, everything is steady. And this approach, as you might have seen over the last 5-6 years, we have had several issues both in terms of anti-dumping investigations and a lot of other trade barrier related problems. We believe that this solution takes us away from all those issues, and we are working very hard on it. So beyond that, at this point in time, I am sorry I am unable to share.
Okay, sir. Sir, this new 75,000 ton middle liner capacity, what is the current utilization rate and what is the timeline to reach break even, and what kind of utilization we may expect in next 2 to 3 years time frame? And how does the margin profile of the new rubber composite liners compare to your traditional grinding media? And when we can expect these lines to be materialistic revenue contributors maybe over the medium term?
Hi, this is Kunal. I think mill liners are while we've spent and done capex and hence talked about that particular product line, you will have to look at everything that we do as an offering, because we are offering a solution. I think the tonnage of mill liner per se is not always important. It's a beachhead for us, because that brings in a lot of process improvement. The volume may come from grinding media, right? Because we are selling things as a package. We are trying to sell things as a solution. I think we give overall guidance, and the overall guidance that we give will include all mining parts that we are selling, which will be grinding media and mill liners. And mill liners, when we say that, includes rubber liners also. I think it will be difficult for us to give a product-wise utilization or growth plan in that sense. So, like Sanjay bhai said, we are making efforts. The first milestone is there. We'll share an overall guidance, whenever we believe that we have enough visibility and confidence on that conversion number.
Okay, sir. Sir, I think overall 4.6 lakh ton per annum capacity. I think we did nearly 1.28 lakh. I think it comes annualized run rate of around 2.6 lakh metric ton, that range. It's almost 55 to 60% kind of utilization. And what kind of utilization we may expect, like 70-80% kind of rate? And what are the specific projects in terms of capex, whether we focused on debottlenecking or new product lines or geographic expansion side? If you get more clarity on that capex, that would be really helpful.
So first and foremost, you're right at current capacity utilization level around 55-60%. Please understand it's a mix of various products. So we have grinding media, we have liners, we have castings, we have a mix of all the products that we give as a combined blended capacity. But two main products, one is castings, which includes liners and everything, tube mill, and all other cement, mining liners, etc. And the castings are what we call them as VSMS, that is vertical spindle mill spare parts, the bigger ones. And then there is a grinding media as a mix. We work on a very long-term customer acquisition and maintenance basis. So we have to always make sure that after all the efforts that we put in, and as you have explained in the past, it takes me almost 2 years, more than that in some cases, a little less than that in some cases, to convince the customer that their solution is right. Now, when a customer comes for an audit, our audit, he should never get that feeling that we don't have adequate capacity to take care of his requirements, and therefore we are always a little ahead in terms of capacity creation, because that process, even if it is a brownfield project today, it takes 1.5 years. If it's a greenfield, it might take 2 years, 3 years. If I have to procure more land and start from the scratch. But on an average, theoretically, I can go up to 70, 75, 80% utilization, and therefore we are constantly year over year consciously taking care that we always have some additional capacity available given the nature of our business and customer relationships.
Okay, sir. So what kind of capex numbers maybe next 2 years time frame?
Is year, we have already guided for a CapEx of about 180 crores. We have incurred about 40 odd crores. This includes, of course, investment in my the subsidiary company MPS, plus my hybrid and renewable solar investment that I am planning to make about 30 crores in this year, plus some maintenance capex, some general capex, etc. Plus some investment that we'll be making in Ghana and China, that is the new facilities that we are in the process of creating. So on an average, I think if you want to take an average annual capex, currently you may take a number of around 150 crores.
Got it, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Raman Kirti from Sequent Investments. Please go ahead.
Hello, sir. Can you hear me?
Yeah, clear.
So, congratulations on a stable set of numbers as well as on winning a recent order from Chile. I just want to understand that we recently won a Chile order. Can we expect a volume uptake in the second half of the year, because it's a 18 months order? So it will be, if my understanding is right, it will be starting to be you will be starting to execute those orders from this coming quarter.
Yes, we expect the offtake to start from Q4 of this year, and it should go on as per the requirement of the customer. But as Kunal explained, on an average, on an annual run rate, you can take around 12 to 15,000 tons. So maybe this quarter we may ship around 3 to 4,000 tons. This quarter, the last one, fourth quarter, we already started production.
Okay. And I just want to understand what will be the realization difference when it comes to our average realization, which are around 163 rupees versus this Chile order. Is it a better realization?
It is not comparable for two reasons. We only share the blended average realization number, where if it is grinding media, it has to be on the lower side. If it is castings, if it is liners, it has to be on the higher side. It ranges from 100, 110 rupees a kilo all the way up to 300, 350 rupees a kilo in terms of my different products. So this particular order is grinding media, so it will be always on the lower end of the spectrum. And hence it is not comparable.
Okay, sir. And sir, with respect to volume growth, what is the volume growth are we expecting in FY27?
So as I said in the beginning of the call, we believe that from next year onwards, at least 30,000 tons plus annual volume growth is what at the minimum level we are expecting or targeting, I would say. Given the new initiatives that we have taken over last 24 months, 12 to 24 months.
So 30,000 additional, right? From the
yeah, of course, incremental. And that too, I want to make a cautionary statement here. We are waiting for the outcome of these couple of more very large successful orders, and then we will really give you a proper volume guidance by the end of this year. But this is the minimum I'm talking about, the minimum targeted. It has to happen. This is what we feel.
And by when are you planning, when do you expect the trial orders to be, the trial products to be converted into orders?
One order will be reaching the final stage of trials around December end. Another one will be by Jan end or mid-February. But again, let me tell you, these are not where they are working, but these are really most important or extremely, I would say, game changer kind of situations where then it can open up a very, very big opportunity, because many people are waiting and watching for the outcome of these trials.
And so my final question is with respect to...
At any given point in time, already working with 20, 30 mining sites. But then, there are different stages, some of them small, some of them medium. These are the ones which are relevant based on the new approach which we have adopted.
Understood. Understood, sir. Sir, my final question is with respect to the overseas operation. We have a unit in Ghana as well as China. What's the current capacity, operational capacity, and what's the utilization at that of those capacities?
There is, I think I don't know where you got that information from. We have only announced a plan and an intention to set up plants outside India. We want to be very careful. We'll be doing smaller modular plants, and as we stand right now, we're in the process of acquiring land, applying for approvals. We will share a firm plan once we have things on the ground. We've never set up a plant outside India. It's a greenfield facility. We have only announced an intention to set up 2 plants, and we are working towards strategy to do that. And once we have clarity, we'll be revisiting some of those, decisions in terms of scale, size, capacity, and we'll share that update once we have absolute firm idea when we start implementing the plant. Till that time, our capacity continues to be in India.
So the entire 460,000 tons per annum capacity is in India?
Of course, yeah. Correct.
Okay, understood. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Varun Jain from Dalit Capital. Please go ahead.
Yeah. Hi. Good evening, sir. So I have a couple of questions. So my first question is that if I look at your H1 FY26 and versus H1 FY25 volumes, so in mining there's a minus 2.5% degrowth, but the other segment is growing by almost 10%, 9.7%. So this is driven by cement or thermal or what?
Nothing to read. These are just timing things, my friend. There's no meaningful reason for that. It's just a quarter in the sales that added up to this.
And this 10% will it continue for this entire year, like it was in H1?
By 250,000 tons, I can't explain for 2,000 tons plus and minus, no? I mean, that will happen. I don't know. Between getting an order, producing it, dispatching it, delivering it, invoicing, there are timing differences. Companies have shutdowns, maintenance downtimes, issues. I mean, all that happens. So this is just, a operational plus adjustment between 2 quarters. Nothing more than that.
Okay. And the other question is that you have guided on EBITDA margins close to 24-25% as sustainable. So Q1 you said product mix was very good, so you got 29.5. But even in this quarter it's close to 28.3. So will the margin remain at these elevated levels at 28% plus levels for the next 2 quarters also, or this quarter also has a favorable product mix or something?
I can understand your question that things are worse than what I told, 2%. If you have done better margin, I mean, I will let it be at that, right? Our guidance is what we believe we should share with everyone and what we can defend. It continues to be at not even 24, it's 20 to 22% operating margin. We've done better. There are many factors that come to play. We'll not be guiding a different number. That is something our performance is up for there. We, as a policy, will not be guiding a profit figure beyond that.
No, sir, that is fine if you are not guiding, but can you tell us the reason why in Q2 it was so high, 28.3?
Exactly what you said. There is foreign exchange, there is raw material adjustment, there is transport costs, there is product mix, and it is impossible for us to strip out every single item and keep explaining where. So it's a combination of those things,
So I'll just clarify a few things. See, one, you are right, our margins are good. What we are factoring is that when I go for a significantly higher volume, when I start getting the orders, so that volume is predominantly going to come from grinding media. Correct? So today my product mix is extremely comfortable. So I have a very high value added, high profit making products also as a part of the mix which play a dominant role. But when a grinding media plays a dominant role, when my volumes go up sizably, naturally the average realization and the margins would change, and that is why we are saying that we feel that while our guidance was 2022, on a more optimistic or a more positive note, I feel we have said that around 24 can look sustainable. We are doing better because we have an extremely favorable product mix. That's the primary reason we are doing very good. But as the product mix changes, this can change. Therefore, in all wisdom, we are saying, please don't factor anything beyond 24 or 25 on a long-term basis. When I reach 300,000 tons or 350,000 tons or 400,000 tons, this can definitely change.
Okay, sir.
I can do better, but it's always better to guide or give a picture on a conservative side and then do a little better. And this is the reality of the situation.
No, I understand, sir. So I just have a last bookkeeping question. So in Q2 FY26, your year-on-year realization has fallen, yet gross margin is up by close to 418 bips. So is this like some one-time low-cost inventory you had or something? And also in Q2 FY26, this export incentive has risen very sharply. So just last two.
No, so there are two aspects. One, again, although I may sound boringly repetitive, the fact of the matter is that a quarter-over-a-quarter gross margin movement cannot and will never indicate a sustainable trend because, for example, in one particular quarter, say if I have shipped out of that 63,000 tons, if I have shipped 15,000 or 18,000 tons of liners plus castings, the needle can move completely different. In the next quarter, if that number falls to 12,000 tons and my grinding media goes to 50,000 tons, again the needle will change. My more clear suggestion would be, please look at us on a little longish, maybe over an annual basis or a half-yearly basis, and then don't try to work out the trend or don't read too much on a one particular quarter. Having said that, we are very comfortable, we are profit-making, we are generating good cash, everything is comfortable, we are working very hard on now major breakthroughs and that can and will definitely make a difference in the times to come. But एक particular quarter में अगर कहीं भी कुछ भी change हो गया, should not be read as a trend setter.
Okay. And just one last question I want to squeeze in. This order which you got from Chile, is that your first ever order from Chile for high chrome grinding media?
I'll tell you. We all know that Chile, Peru, they are very important markets from the point of view of copper, gold, or the minerals where we are targeting. Correct? So we've been working on Chile for more than 2-3 years. This is the first major order we got. And the idea was to show that this is a breakthrough. Internally, we are treating this as a breakthrough because we got that entry into a very tough market on a substantial basis. You get my point? And that becomes a trend setter, according to us. It also becomes a very important reference point. So it's not the first order, but it is one of the first major breakthrough orders. I would put it like that.
Okay. So anything above 20,000 metric ton you would classify as a major order. Am I reading it right?
At the board level on the materiality, we had a discussion today. We are working on it. We will probably look at a 15,000 ton plus as a materiality threshold, but we'll come back to you.
Okay, sir. Thank you and all the very best.
Thank you.
Thank you. The next question is from the line of Deepan Shankar from Trustline PMS. Please go ahead.
Good evening, everyone, and thanks a lot for the opportunity. Firstly, considering there is substantial potential for high chrome grinding media for further conversions in the market, what are the key challenges faced by the company in these kind of conversions? Especially, what is the price gap between this forged grinding media and high chrome, and how the gap has widened over the past 3 years?
So, my friend, the question that you asked is an extremely pertinent question which goes to the very core of our activity. So, first and foremost, let me elaborate a few things. I understand that you perhaps have not been tracking us for a very long time. So what our whole forte is that this particular market of grinding and crushing in mining, we are focused on gold, copper, and iron. As an opportunity, this is about 2.5 million tons. Predominantly, the penetration of high chrome solution vis-a-vis conventional forged or other material solutions, the penetration is 25-30%. So we are talking of a 60-70% opportunity, which is 1.5 million or even more for these three specific ores. Challenges are many. We are in India. So our solution is not only based on cost savings, that is how we had initially started. The fact of the matter is, as compared to a forged grinding media or any other material of construction for liners, our solution works in three directions. One, it straight away saves cost of this consumable wear parts, which is 8 to 10% of this entire mining process cost. Point number one. But that doesn't change the needle because there are multifarious challenges. These mines are extremely powerful, completely decentralized, localized, large operations. Nobody is interested if you go and say that, hey, I'm going to save you a few $100,000, etc., etc. So then, over the last 7-8 years, we have now made us a very, very formidable force by changing our solution to one, not only on cost saving, but saving on sizably increasing the throughput of the mines for the same or similar cost they are incurring on the same products that they are buying conventionally. So if, for example, it's a gold mine where input-output ratios are extremely adverse, if I say that on a $5 million purchase of my grinding media or a liner or as a package that I'm offering, if I am improving your throughput whose value is 25-30 million in a year or in a 50 million in 2 years against a 5 or 10 million that he pays me, he is not only saving on the cost of this material, but he is completely changing his equation of the balance sheet. Third, my solution now saves a lot of power cost. These operations, mining operations, are extremely capital intensive. Our area of focus is grinding and crushing from the sag mill stage up to primary, tertiary, secondary, tertiary, and beneficiation. These are extremely capital intensive operations where if I'm able to improve throughput, save power cost, my solution goes far beyond cost saving. And this is what we have earned over a period of last 3, 4, 5, 6, 7 years of very hard work. That is where I am getting a little more confident when I talk that now I'm approaching mines not simply saying that I will save you money, but saying that I will improve your entire efficiency and it will be a game changer for you and you pay me the same price you are anyway paying. This is the difference. But it's a bit complicated. Our mining customers are very difficult people. It takes a very long time for us to convert. But now the opportunity is massive and we believe we are geared to take that opportunity. I think on this call, beyond this, to spend more time on that question would be unfair for the other participants.
Okay, sure, sir. And like when we look at this Megatech's available financial information, for the last 2 calendar years, they were able to grow at 10 to 14%. So have they gained more market share in this, or the most of that has only come from the grinding media, not from micro?
No. So Megatech's first, now our competition frankly has moved away and we are still very, very focused on the forged grinding media players who are, so Megatech's in their own, so they have multiple plants. Megatech's is a very complicated scenario. There are some 14, 15 plants in 12, 13 locations. Some of them good, some of them not so good. They also have licensee relationships. So beyond that we can't comment, but frankly we are not really focused on Megatech's as a competition.
Okay. So lastly, in the last couple of quarters, we have been saying that there is inventory ramped down by large customers. Potentially could be 20 to 30,000 tons of volume. So are we expecting these volumes to come back at least by next year?
So it is not a question of volumes coming back, but our entire focus is on gaining incremental market share and volumes in new set of customers that we are talking. Of course, some of these volumes are bound to come back because now, things have settled down quite a bit. But we offer our solutions to several mines across the geographies, and therefore we are not really worried about one particular geography, or rather agnostic if some volumes do not come back the way we anticipate from, say, Brazil or Canada. It's not that needle changer. But yes, overall we are very focused on the new customer acquisition.
Okay. Thank you and all the best.
And one point I forgot to mention on Magotteaux, they are also into non-high chrome, which can be giving more volumes. We are not into that segment at all. Okay.
Understood, sir. Thank you.
Thank you. The next question is from the line of Priyankar Biswas from JM Financials. Please go ahead.
Good evening, sir. Am I audible?
Yeah.
Yeah. I heard from the commentary that right now, trials are going on at 11 large mines. So if I look at it like a prospect pipeline, if on an average it's something like a 15 KT types opportunity, each one of them, would it be right to assess that it's almost close to a 150 KT type opportunity of all the 11 mines were to eventually convert to high chrome? Would that be a fair assessment?
Sanjay was just trying to answer one gentleman's question where we've been asked in 20 different ways to give some guidance, and we are trying to explain why we are not able to share a guidance, right? Short of a guidance, what work are you doing? We have 10 mines we are working at it. I think we are doing work at more than 50 mines across the world in different stages. There are at least 8 or 10 where we are in advanced stage. There are, maybe 10 or 15 where we are, collective work that we may be doing, maybe prospecting work, maybe more than 200 to 50,000 tons, correct? But that's at various levels of work. And where does it convert? How long does it take? Whether it's a job? I mean, there are plenty of things linked to that. The question is not the opportunity. The question is a larger context in which we operate, where there's an incumbent. The incumbent has been around for a long time. The customers are conservative. It takes time for them to. So all our effort is to make sure that our value proposition becomes better and sharper and more value added. That's what we're doing, right? And which is what finally, and these are things, only when we do hard things do we make the kind of margin that we make. You get it? So the idea is that for us, these are hard things. These are things where there is no straightforward signaling to say, I will do this amount of growth, and which is where is our business at, right? So more than 10 mines, I think our prospecting work is far more. And to answer your question, yes, there will be at least 200 to 250,000 tons of prospecting work that we're doing.
Okay, that's extremely clear. Also, like in the let's say the copper belt of Latin America, can you give me a sense of what is the high chrome penetration there? The reason I ask is, if it is a very under-penetrated geography for high chrome, for example, then we can potentially see a lot of growth. I mean, multi-year types of growth. So, and what sort of share? Yeah.
Except of Brazil, Chile, Peru, which are the large copper producing regions, there is absolutely none. The breakthrough that we did is the first high chrome in that region for copper.
So Kunal bhai, if this region were eventually to convert, I am not saying it will happen in 1 year, but let's say in a 4-5 year view. So what can be the potential levels from this geography?
I think the region consumed close to, I think, forged players sell close to 700,000 tons there. So, I mean, that's the math.
So even if we, let's say, reach a 20% penetration, that will also be a huge market. So that would be the understanding.
You're right. That's what our whole efforts are. Bang on.
Okay. Very clear. Also, just if I can squeeze in, there were, any impact from the tariffs in US so far? Like, are the US customers still taking the volumes? Like, how are the volumes trending over there?
No, so, we are continuing selling, and the customers are paying the duty but mind you, this is not the reciprocal tariff. This was the sectoral tariff which was initially 25% imposed in the month of February against steel and aluminum, and somewhere in May this was increased to 50%. Correct. So customers are paying, they are continuing to pay. There is of course some negotiation, some slowdown with some customers who are a little reluctant to pay, but we are not bearing. We sell only to those customers who pay the tariff.
Okay. And if I can squeeze just one last one. So recently a competitor has bought Molycop. So do you think that from your business strategy, would it make a significant level of difference, especially in the grinding media or the mill liners as a result, like if Molycop really gets revived in a way? So what are your views on that?
I think we were competing with Molycop for last 7, 8, 10 years. Molycop with $300 million debt is better, or a Molycop with $800 million debt is better on a $150 million EBITDA. I mean, so yes, there is some ownership changes. There was a previous owner that tried lots of things to, make changes in that. Forged is not our terrain. That's not a product that we operate in. Forged is a product, right? And hence Molycop's offering is a product. AIA is a solution company. We are selling an alloy-based product. We are doing design engineering on it, and we are ultimately offering a solution that saves, significantly more than the investment that they make in our parts. So to that extent, if a product company has gone through ownership changes, I'm not sure how else would we respond to. But there is financial leverage, and that itself, doesn't make us feel nervous. Otherwise, we have to keep doing what we have to do, right? We are staying in our lane and working to make sure that we focus on what we do well and making our offering even more, extraordinary as far as value addition to the customer is concerned.
So you are not too worried about it. So maybe the AIA business will remain as usual. I mean, nothing about it.
It's nothing for us. We are absolutely. I mean, we are just a observer like any other, participant in the trade. That there's something that has happened. Good, they'll go through their own journey, whatever that means for them, right?
Yes. Absolutely clear. Thank you so much.
Thank you.
Thank you. The next question is from the line of Devang Bey from BD Enterprises. Please go ahead.
Yeah, hi. Am I audible, sir?
Yes.
Yeah. So majority of the questions have been answered. And regarding the 4,000-5,000 crore cash we were holding out, and we are expecting some good news coming in within the next 3 to 4 months maximum. What we are expecting. Now, my only a minor question is there, because I think so. There is a subsidiary company, Wellcast, and you have closed down the plant.
Yes.
Any update further on that? Because I don't think so that, I tried to call multiple times on both the numbers which was given on the announcement, but not a single number was reachable. So can you just guide me out with that, because I'm holding some shares on that one also, sir.
So Devang bhai, Wellcast closure, we already made an announcement that it was not viable for Wellcast to continue, given the fact that, it was a very old plant, it was a very, awkward location, and for us to, as a shareholder, major shareholder as a holding company, to invest anything in Wellcast was not making sense. More so, particularly when we have created excellent infrastructure here in Gujarat, and so it was more driven by the commercial consideration, nothing else.
So any plan to either the company is going to get it merged out, or because?
No, so as of now we have not made any such plan. In fact, if you remember, a couple of times we had tried to delist Wellcast also, but we did not meet with any success, because we did not get the adequate number of shares which is statutorily required. But this is where the situation is. As of now, it's a standstill.
Okay, that's fine, sir. That's all from my side, because nothing else.
Yeah.
That's fine. Thank you, sir.
Yeah.
Thank you. The next question is from the line of Raja Kumar from RK Investment. Please go ahead.
Hello.
Yes.
Yeah, thank you so much for the opportunity. Good evening, Sanjay Bhai and Kunal Bhai. Sir, just two questions. I see the standalone much better than your consolidated profit in June 25 and September 20.
Sorry to interrupt, Raja. Your voice is breaking.
Yeah, can you hear me now?
No problem.
Yeah, let him continue. It's okay.
Yeah. So the question is, your standalone profit performance better than your consolidated performance. So is it due to some of the subsidiaries not doing well, or is it more like you sold the material and the material is remaining unsold in the console?
So, Mr. Raja, I want to make one thing very, very clear. My subsidiaries are, except for MPS, all of them, which is a small design-focused subsidiary company that we have recently acquired. All other subsidiaries are fully integral marketing linked subsidiaries. Therefore, you should only look at our consolidated numbers and not my standalone or subsidiary standalone numbers.
Okay, got it, sir. And yeah, I understand now. Sir, the second question is, I see that note number 8 in your financial statements. You have mentioned that one of the subsidiaries factory has been shut down. And so I just want to know, given that you are expanding, so we have not explored using that capacity for any other alternate purpose. Any reason you are shutting down?
In one of the previous question, I think that note pertains to the shutdown that we have recently announced of Welcast steel plant, where I explained it's a very old plant. The location in Bangalore, in the heart of the city, it was not viable for us to make more investments into Welcast so as to make it operationally viable, and therefore, in the interest of financial prudence, we decided to shut it down. You don't need anything because at the parent level, we have sizable capacities created here.
Okay, sir. Thank you so much.
Yeah.
Thank you. The next question is from the line of Lokesh Manik from Delma Capital. Please go ahead.
Hi, good evening, Kunal Bhai and Sanjay Bhai. My question was firstly on the new package solutions you spoke about earlier in the call and how it moves you away from the entire ADD fiasco. So just clarification here is it now the technical description of the product that puts you out of the net, or is it the pricing of the combined solution is such that no domestic player can shout dumping?
So I would put it like this, that we are offering this as a complete package where individual items are rather, they become insignificant. So this package works as a complete total 360-degree solution where we move away from price discussion of a particular product. I mean, at this point in time, I can share only this much.
Fair enough, sir. So secondly, if you can just give us a sense of what would be the penetration of this solution in our existing business to as a percentage of total customers or volume, whatever you may want to share, just to get a sense of how we are progressing on that front, converting customers.
Most of our sales will come from solution sales. Most of our sales, going forward, large breakthroughs are linked to these solutions.
So with the trial runs you spoke about, that are scheduled to be completed in January, would it be a fair assessment? 30-40% of the business now would be these package solutions that we would be entering?
I think what Sanjay Bhai is saying is that important trials are in place. Those trials mean we will do more about it. This is efficacy of high chrome grinding media. It's an efficacy for overall solution, right? It's a two-level approach that we have. The first breakthrough for high chrome is done. where there is some bit of solution. There is more of solution that we are working on, but these are all, the minute we get into a rabbit hole where there's no answer, right? So just bear with us. All we are saying is, there's interesting work going on, and once we have clarity, we will share numbers for people to build, future guidance on.
Just to clarify, when I say a package, it's a unique lining-based solution coupled with linked grinding media, which is offered as a package. So my products remain the same. It's not something new that I've invented, but it is the efficacy and the solution that I'm offering as a package, which is the game changer. You get the point? So liner मैं बनाता हूँ, grinding media मैं बनाता हूँ, वही मैं देता हूँ, but it is linked and it is balanced. Which I think honestly no other competitor in the world is offering today. This is the uniqueness. And which through intense research, innovative design, there is a lot of hard work has gone into this.
Great, sir. So last question was on the just the substitute, if I may say, call it a substitute, which is a forged grinding media. Then let's say a competitor we spoke about in previously, Molycorp, which has been acquired by one of the Indian players. And they are, 5 years in that mill lining space. So can they also come up with a similar solution, or you think that high chrome grinding media far outpaces that kind of a solution, even if they were to come out with it?
See, in all modesty and not to sound, arrogant or anything, very honestly, theoretically anybody can do a research for 5, 10, 15 years and try to come out with something. But one, Molycorp is a predominantly forged player, and we are replacing forged with our solution. Correct. Now, the other Indian player competitor you talked about, they are technically into liners. We are also into metal, foam or rubber or composite liners, but what we offer as a unique design and as a combination, and with a kind of a guaranteed throughput, etc., I don't think they are anywhere near in terms of the capability. Having said that, yes, technically, theoretically they can, but it's going to be very, very difficult. It will take a lot of time, if at all, and I think at this point in time, nobody in the world is offering this. Globally, nobody.
Very heartening to know that, sir. Very heartening to know that. Thank you so much. That's it from my side.
Thanks.
Thank you. The next question is from the line of Mayank Bhandari from Asian Market. Please go ahead.
Thanks for the opportunity. Just one clarification on the gross margin. Are we baking in the lower steel prices here, and what would be the guidance? Will it improve sequentially from here on?
See, our gross margins are around 38 to maybe 39% generally. We always work with a complete pass-through kind of a scenario. Currently, for quite some time, the prices are a little soft. Particularly, ferrochrome is quite a bit steady. But if at all, if something, and again, it's a function of product mix, as I said, but it's not really something that causes us any concern. There's always a lag of 1 quarter or 2 quarters, and we normalize any changes in the cost structure.
So we are more dependent on steel or ferrochrome?
No. So in terms of value, 50% of my raw material cost is ferrochrome and 50% could be scrap. But in terms of quantity, almost 70% is scrap and 25-30% is chrome. And there is absolutely no problem in getting that.
Okay. And sir, on this high chrome thing, I mean, as I go back and touch that, we have a patent towards this product, and we understand that is there any increased Chinese competition in this high chrome market, or have we seen anything sort of that?
Chinese players are very much present globally also, but I don't think anybody can come really nearer to us in terms of the solution or the advantages that we are offering.
So high chrome offering is there, but it does not matches the exact quality that we offer.
Yeah, I mean, that high chrome product that they offer is more like commodities. What we do is a part of a package solution, which is very unique.
Okay, thank you very much.
Thank you.
Thank you. The next question is from the line of Vipin Goyal from Marelli Limited. Please go ahead.
Yeah, hi, Kunal bhai, Sanjay bhai. Vipin Goyal from Mirabilis. Heartening to know about the exclusivity of the bundle solution that you talked about for the two mines. Small question here is, are these two mines, two sites, completely new customers to us, or is it being done for existing customers where we are pitching them incremental solution?
It is for new customers.
Okay.
If you run through our last few transcripts, a lot of these questions will get answered. I don't want to take everyone's time on these questions, and we are happy to take questions offline if you still have any. Yeah?
Great. And sir, just one more on the package solution that, apart from this, barring these two mines, if I just take the purely just based on the Chile order, is it good to assume that as of now, today's visibility, 12 to 15,000 incremental volumes are for sure for certain for next year?
Exactly. The new order that we've got, correct.
Got it. Thank you.
Thank you. Operator, we can take one last question. Yeah. Thanks.
Okay. The last question is from the line of Varun Jain from Dolat Capital. Please go ahead.
Yeah, hi sir. So just touching upon your previous comments. So you said that you are a solution-oriented company because you have, mill liner and grinding media. Now even they have both of these things, and they had a call where they
further comment on Molycop. Hear me, my friend. I will not. You have to ask these questions to them. Yeah.
So they said that they are. No, sir. So the question was.
Yeah.
Okay. So they basically had said that they have grown, their high chrome media from 0 to 62,000 MT in the past couple of years, and they target 200,000 MT. So they have been growing in the past year. So can you tell us where this growth has come from and whether they have taken some market share from you or what?
We are not aware about their high chrome business. We do not see any high chrome from Molycop or from Tega in markets that we operate in. There are lots of comments and things. It's not right for us to comment about it. Today, as we speak, they are taking my market. We don't compete with them in any other place. I'll leave it at that. Right? They have a public commentary. I would rather that you go and clarify those with that. From our standpoint, we've clarified our guidance and the work that we are doing. I think we'll keep our questions to that. Yeah?
Okay, sir. Okay. Thank you and all the best.
Thank you.
Thank you.
Thank you so much, guys. Again, we are, like I said, largely our business continues as is. A great, milestone for us in terms of our win in Chile. And we hope to build on that and in the next few years create a very sustainable, meaningful presence in South America based on that. And hopefully we'll have better news to share in coming quarters. With that, Sanjay and I will sign off and remain available for any offline questions you may have.
Thank you very much and have a good evening.
Thank you.
Thank you, sir. On behalf of AIA Engineering Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.